Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. Today's topic is very time sensitive because if you are to elect this strategy, you need to do that in most states by March 15. So, what am I talking about? Same time last year, I was telling you about this strategy because not a lot of people talk about it, and it was very, very important. This year, whether you elect it or not, it really depends because of the change in law. I'm talking about the PTET tax strategy, and let's dig in. All right, so let me share my screen and we'll start with today's joke. Tax season is full of jokes, and yeah, I don't have a lot of money, but when I do, you know it is tax season. Okay, so should you elect PTET, pass-through entity tax, in 2026? And we want to navigate the PTET election after the 3 OBBBA sold cap changes. Why? We're going to find out in a minute. So we know that the sold cap have changed from 10K to 40K. So the question now everyone is asking, with this whole cap that now it's a 40,000, actually 40K in 2025, but in 2026 it also increased with another 10%. So it's at 40,400. So now, since this cap increased, do I still need to make the PTT election for my business? And I'm talking mainly for people with business, whether it's a S Corp or any pass-through entity, partnership, or even if it's a sole prop. The deadline is March 15, which is just 12 days away. Okay, or March 16 in this case because March 15 falls on a weekend. So the sold cap has changed. As we know, in 2024, it was 10K, 2025 increased to 40K, 2026, which is the year we have in hand, is 40,400. And it will keep going up 1% annual increase each year. Okay, the sunset provision, we said that this is not a permanent change because it's gonna sunset in 2030. It goes back to the 10K that was there last year. So the $10,000 cap becomes permanent after 2029. So that's why this is something temporary. But still, the PTT remains a very valuable long-term strategy, especially for this reason. Okay, but there is something that may make this strategy available for others, but not for some others. What is it? The cap that it's not available to everyone. Why? Because it phases out at a modified adjusted gross income of 505K in 2026. What's going to happen after I reach that level? After you reach this level, you start to see a reduction of 30% of income over this threshold, over this amount. But still remains a minimum floor of 10K that you never go below. Okay, so let's talk an example. If you're a married couple, you have a 550K in modified adjusted gross income. So the threshold, remember what it was for 2026? 505. So now you have 45K above the threshold in modified adjusted gross income. 30% of that excess is 13,500. So instead of you taking the 40,400, you reduce that and the available SAL deduction would be 26,900. So instead of taking the fully 4,400, you reduce that by 13,500 and you go to the amount that you only can deduct is 26,900. Thank God for the softwares that they calculate this for us automatically. But it's just for you to know how the numbers work. Okay, so it's still beneficial, but you're not getting the full 40,400. So what if now your modified adjusted gross income is at 750K? Now you're above the threshold, the 505, with the 245,000. 30% of that is 73,500. Does that mean that you get absolutely nothing? No, you get the minimum floor, which is the 10K. So you go back to the old cap as if nothing has happened. So that's why how much income you have would determine whether the PTET is still a good strategy for you or not. So again, what's PTET? PTET is pass-through entity tax that allow you to take a state income tax deduction at the entity level. So that's saying if you're having an LLC, single member LLC, sole prop, partnership, as corporation, you pay these taxes on the entity level. You don't pay it as the individual. It's 100% deductible at the entity level on the federal state, and you get a credit for it on the state level. So on the federal, you get a full deduction, and on the state, you get a credit for it. And it's not subject to the SOLD cap. So whether it doesn't matter how much income you have, it doesn't matter how much income you earn, it doesn't matter how much taxes you pay for other things like property taxes, personal property taxes, real estate. It doesn't really matter. It doesn't matter if you have a W-2 and you pay tax on it. Nothing of this matters because you take full deduction. So it's definitely, and the only reason this strategy came up is to go around the 10K cap in states that has high income tax like New York, New Jersey, California, all these states. So to work around it, they created this strategy. But because of the changing cap, now people asking, does it make sense to me or not? So that's why we're explaining this, why it may matter and why it may still be valuable strategy to use. So the key differences, as we spoke, and if you're still following me, the key differences between the sole deduction and the PTET, that the sole deduction, the state and local tax deduction, it's on the individual level on your Schedule A. It is subject to the cap and it's subject to the phase out. Depends on your income, and you must itemize to be taking that deduction. If you're taking the standard deduction, then you don't even worry about it. PTET, it's an entity level deduction. On the entity level, there is no cap, there is no phase out, and it reduces your pass-through income because now the income that you get to report on your individual tax return is already accounting for this deduction. Okay, so that's the key difference between the two. So when does BTET still make sense? If your income exceeding the phase out zone, then definitely makes sense because you're not making use of the increasing cap. It's as if the law has nothing to do with you, so you still have to do the PTET to reduce your taxes. Estate taxes exceed 40,000. If you're paying a lot of estate tax, if you're operating in multi-state and you're paying too much taxes to the states, then this may still make sense to you. And it also reduces your self-employment tax because it reduces your taxable and your net income. So it reduces your self-employment tax. So if you're a partnership, this may make sense to you. If you're a general partner in a partnership, this may make sense to you. So PTT may still make sense in a lot of cases because it has a lot of hidden advantage, and that's why I keep talking about this every year. You need to do this. You need to elect the PTT because it reduces your AGI, it reduces your MAGI, your modified adjusted gross income, which affect us. Now you're taking it above the line. You're taking it into the calculation of getting into the AGI or the modified adjusted gross income. And it helps with improving your QBI deduction, the qualified business income deduction. So now you get 20% also deduction. It improves this calculation. It makes you eligible more and it reduces the alternative minimum tax exposure. Now, again, as long as you're reducing this, you're helping yourself a lot in a lot and with a lot of things. And it gives you predictable federal tax treatment. So the very like beneficial way of doing the PTET. Okay, when sold cap may be better. So in some cases, I would tell you, no, you don't have to do the PTT this year. Just keep going. That's if your income consistently below the 505, if your state taxes are less than the 40K, if you're operating in just a single state, and if the PTT is creating administrative burden for you. Because still, when you do PTT, you need, and that's why a lot of people don't talk about it, because it's burdensome. It requires some work. It requires updated financials. It requires estimated taxes. It requires you to file quarterly reports and pay quarterly taxes and be in compliance. So it's a hassle, I have to say, but sometimes it's really worth it because the savings are great. So depends on whether it makes sense to you or not, and whether the savings and the numbers make sense to you or not. You get to choose whether you elected for 2026 or not. So now with New York, if you're a New York business, then the deadline is March 15, and this is the same for a lot of other states, but you may need to follow your state and where you operate instructions. The deadline is March 15. The election, you do it via the New York State Business Online Service, and you have to do it as a business owner. Like me as a tax practitioner, I cannot do this election for you. You have to do it yourself. It has to be annual. You have to do this election each year. So if you did it last year, you don't go automatically for it. You have to make the election every year, even if you elected it before. And after you do the first estimated payment, it becomes irrevocable. Like you can't go back and say, oh, I changed my mind. I don't want to elect it this year. It's irrevocable. Again, hassle, but it makes sense for a lot of people numbers wise. So for you to take the decision, you really need to calculate your 2026 projected modified adjusted gross income. So whether this is close to be similar to 2025, or whether this is going to change significantly, you need to calculate that. And you need to determine the available SOL cap after the phase out. So based on how much income do you have, you need to determine how much SOL would be still available to you, and you estimate your total state income taxes. And from here, you compare whether you need to take the PTET versus the SOLT itemized deduction. So having 2024, 2025 numbers would help you a lot with that, along with any changes you have or you're expecting to have in 2026. And to be honest, if you really don't know, then just go for the election. It doesn't hurt. So the action step that you need to do: review your 2025 tax return and state tax liability, project your 2026 income and state taxes, run the comparison PTET versus SOL scenarios, and make the election by March 15 if beneficial. So don't assume that the higher SOL cap is eliminating the need to elect the PTET, because for high income earners in New York, New Jersey, Connecticut, California, PTET often remains the superior strategy. So don't just go that, oh, now that they increased the cap, I'm good to go. I don't have to worry about PTET anymore, because that's not the case in a lot of cases that I've seen. So the common mistake to avoid, that there is many business owners that are skipping the PTET because they're assuming that the higher SOL cap makes it unnecessary. The reality is that the math often still favors the PTET for medical practice owners and high income professionals. So questions for your CPA: what's my effective SOL cap after the phase out? How does PTET affect my QBI deduction? Do I operate in multiple states? What is the federal tax saving difference if I make the election or if I decided not to? So if you have any questions, if you want to know whether this would apply to you or not, just make an appointment with me on the calendar, have your information ready, and we can talk numbers, and we can advise you on your like specific situation. All right. Hope that you find this helpful. And if you need more resources, if you need anything, please let me know. Thank you and happy tax season. See you next week.